those of us who have read your writings over the years know that you predicted this financial crisis of the last year, but you predicted it about 10 years early.
More than once.
And more than once,
times,
yeah.
yes.
So why did it take so long to get here?
Well, because I think that the authorities did everything they could. Whenever a financial crisis arose, they took care of the failing institution, merged it away. When necessary, they provided fiscal stimulus or monetary stimulus, and each time they managed to get us out of financial crisis without seriously damaging the real economy. And doing that actually inflated the bubble. I proposed this idea of a super bubble that has been growing for more than 25 years. And every bubble has a trend in reality that really is happening, and then a misconception or misinterpretation of that trend. And the trend that has been happening is the ever-increasing use of credit and leverage. And the misconception was that markets are self-correcting. And the authorities, by actually stepping in and saving the system each time, reinforced both the use of credit and the misconception that markets are self-correcting.
And are you confident now that the bubble has burst, the super bubble?
Well, I think the evidence is pretty conclusive. Now, and you actually had this time a total breakdown of the financial system, and it had to be put on artificial life support. This happened, the big event, the game-changing event, was the bankruptcy of Lehman. And within a week, you had to put it on artificial life support. Now, you know, as the markets are reviving, a lot of people would like to continue as if it hadn't happened. So there's, I can see already the sort of the let's get back to business as usual.
Is there danger in that attitude? Is there any danger that you do what you say happened the last couple of times, which is just reinflate the bubble?
Well, we are actually reinflating the bubble right now, in the sense that we have had this excessive use of leverage. But to correct it, you can't correct it directly. You need two steps. One is to replace the collapsing credit with the only source of credit that was still credible, which is the state. So we've been expanding the balance sheet of the Federal Reserve at an incredible rate, and we've been giving guarantees out. So the balance sheet went from 800 billion in September 2008 to over 2 trillion, with about 8 trillion of various guarantees, so 10 trillion. Now, that's an incredible expansion of monetary base. Of course, if credit restarts, you have the makings of runaway inflation.
Well, and that's one of the great debates going on. In fact, I've never seen in my lifetime a period where fears of inflation and fears of deflation seem to be coexisting in the markets at the same time. Which of those is, in your view, the greater fear right now?
I think that you are absolutely right. We are sort of veering between the two, and actually we are going to navigate avoiding both. However, as the markets revive, I think the fear of inflation is going to drive up interest rates, which will then choke off the recovery. So this will lead you to stagflation, an experience we've had in the 70s, except that this is going to be perhaps more enduring.
So you foresee years of slow growth, imminent inflation, high interest rates?
I mean, stop go. When the interest rates choke off the recovery, then of course interest rates will come down. So you have stop go.
And is there anything that can be done to prevent that? That's not a very satisfying picture of the future.
I think that is the preferable outcome, because the alternative would be deflation and recession with the weight of debt crushing the economy, because the debt remains in nominal terms, and therefore it increases the percentage of GNP.
So I saw you quoted recently saying that the worst of the crisis is behind us. It sounds like by saying the worst of the crisis is behind us, you're still not painting a particularly rosy picture of the future.
No, I'm not. I think, look, you've got 25 years of excesses that you have to work off. So I can't see how you can resume kind of growth that you had in the last 25 years.
It will take 2 years, 5 years, 10 years? How long does it take to work off the excesses?
Well, it depends on I mean, my theory is that the future is unpredictable. Therefore, I'm not going to predict it. It depends. It depends on how the authorities act and how the markets respond. The future is going to be determined as we go along.
But of course, as an investor, you have to predict it all the time. You make bets based on what you think is going to happen.
Right.
So where are you placing your bets right now?
Well, I see, as I say, I mean, there's always uncertainty. And that's the element that was left out by the financial engineers who were so good at understanding risk. They forgot about uncertainty. The range of uncertainty also is uncertain. Most of the time, we have fairly stable conditions with the range rather narrow. Now it broadened out, and you have, on the one hand, possibility for runaway inflation with the dollar losing its value. On the other hand, you have the possibility of deflation and depression, and of course, we will be somewhere in between. And as I say, I think it's right now. It's the cup is half empty and half full. And 1 minute we see it as half empty, the other minute we see it as half full. And the markets are actually within a fairly narrow range. And I think that may actually be a fairly
and so, as an investment strategy, I'm sorry to push this point, but we're in New York and we have to accept the interests of the group. But as an investment strategy, what do you do?
Well, I play it very close to the vest.
Sorry.
I really think this is not a time to have a firm conviction as there was during the in 08, 07, 08, that there's a big crash coming. It's much more balanced, nuanced, and it's actually it's more of a trading market, I would say, than and incidentally, I'm out of the market now. I came out of retirement in August 07, and I went back in.
Very good 2008.
Yeah, and I went back into retirement beginning of this year, and I'm now sort of at a distance. So I'm not involved on a daily basis.
You came out for 1 year, and according to Institutional Investor, made over $1 billion in that year.
Mm-hmm. No, well, we had a.
That's you personally.
Yeah, no, but well, I run a large fund. I came out to preserve my capital, and I succeeded in doing that and to get a decent return.
Because you were afraid if you didn't come out that
I would lose it.
It would be invested in.
I would be like all the endowment funds that lost 27% or 33%.
So you argue that the fundamental misconception of the last 25, 30 years was this market fundamentalism, the notion that markets, if left to themselves, will tend towards some sort of an equilibrium. You say that's not the case. Bubbles are an inherent part of the way markets work, and we need a regulatory system that's set up to stop the bubbles.
That's exactly right.
How do you do that?
Well, Alan Greenspan refused to accept responsibility for preventing asset bubbles. He said, if the markets don't know, how can we know? And he's right. However, once you know that markets are inherently bubble prone, you have to accept responsibility to countermand, to counteract the prevailing bias of the market when it goes too far. And then you take a step and you see how the market reacts. So you get feedback, and you know that you're bound to be wrong, but the markets will tell you whether you have done enough or not.
Well, so go back to 1996. That's when Alan Greenspan famously said there was irrational exuberance in the market. The Dow Jones average was at 6,400.
Right.
What should he have done?
Well, he should have actually asked the SEC to slow down or be very leery in allowing rapid increases in equity issues by IT companies, because that was a boom that was based basically on equity leveraging, not credit leveraging. It was the fact that you could, if you were ahead of the pack, if you were gaining, since this is you grow by a network grows by being the first, and you gain a position. So being first, you could raise capital at you remember 60 times sales. So the cost of capital was absolutely. So you had to slow it down.
The government should have stopped that, or
no, just slow it down. Just slow it down.
I mean, you have written that markets are imperfect, but regulators are more so.
Right.
Don't you worry that there's a danger that once you've created this authority, that you have regulators stomping out bubbles that don't exist?
Yes. Yes, they will always be wrong, and they have to recognize, that they're going to be wrong, and they should interfere as little as possible. But they also have to interfere because right now they try to control the money supply, and the theory is that if you control the money supply, then markets will take care of the rest. That's false. So you also have to recognize that markets have moods, and you have to control credit conditions as well as money supply. And so when the markets are exuberant, you have to raise minimum capital requirements, margin requirements to counteract it. Keep it within bounds. That's all. You cannot prevent bubbles from forming, because that's the way it is. But you have to prevent them from growing too big and from becoming self-reinforcing.
So you're talking about a Federal Reserve with a great deal more authority than it currently has.
Yes, yes. And you have to reactivate controls that you used to exercise. You used to, margin requirements used to be varied. They are not. Minimum capital requirements are fixed once and for all. They should also be varied for banks. And in the old days when I was young, the central bank used to send out letters to banks and say, don't lend on real estate. Real estate is getting overheated. Don't let your real estate portfolio grow. That kind of direction, which is today considered absolutely sacrilegious, is actually what you need. And there was an article yesterday from the Chinese head of the regulatory agency, which was I recommend it. It's in the Financial Times. The Chinese are using those techniques. They're a little behind us, and we have to go back. He said, return to basics.
There's some people who argue that these bubbles have created all sorts of useful side effects. That there's been that the bubble of the 1990s led to a lot of technology innovation, and the more recent bubble led to a lot of financial innovation. Are you worried about squashing the innovation?
No, I think a little bit needs to be squashed, because there is a difference between financial innovations and technological innovations. Because if markets are imperfect, a lot of the innovations, incidentally, are designed to circumvent regulation. So if markets need to be brought under control, then unlimited innovations can be harmful. That's a difference from, incidentally, some technological innovations like atomic bombs can also be harmful. It's hard to regulate it. We are still working on nuclear, controlling nuclear armaments. So it's not entirely confined to financial innovations. There are certain innovations which are harmful, and the authorities have to approve, for instance, the issuance of synthetic securities, just as they have to approve the issuance of shares.
Do you find it ironic that, as someone who spent a good part of your life and a sizable part of your fortune attempting to extract the governments of Eastern Europe from their economies, that you now seem to be on the leading edge of arguing for a much stronger government role in the U.S. economy?
No, I mean, I've often found myself arguing both sides.
You can have a great debate with yourself.
No, I mean, you can have you can overdo the regulation, and certainly a central planning is absolutely cannot function. Markets are far superior in allocating resources than authorities. So, one of the negative side effects of regulations is political influence. So, for instance, you've got the Chinese system, which is much more regulated, but it's regulated on political grounds. You need regulation on prudential grounds, separate from the. You need to establish a certain distance between the regulators and the political process. This is what we do, of course, with the Federal Reserve and the SEC.
Which is why the power you want to create, you would invest primarily with the Federal Reserve.
It's a combination of Federal Reserve and an SEC that would also control synthetic instruments. I think that the control of the commodities is not very good.
Do you think Chairman Bernanke is the right person to do the job? He also has said, as Alan Greenspan did, that attempting to prick bubbles is not a great idea.
No, I think Bernanke proved to be a fast learner. I mean, he came in and being deeply rooted in the prevailing false paradigm, he said, you know, there is a problem with subprime, but it's 100 billion or whatever, we can easily take it. But then he saw contagion, and he saw it spreading from one market to another, and he learned very fast.
So you've said that this system of the last 2-3 decades has favored developed countries in some ways at the expense of developing countries. Yeah. So as it now unwinds, what do you foresee for China, for India, for the developing world?
Well, you see, I see China as the big winner China was the main beneficiary from globalization, and now it is the main beneficiary of the collapse of the international financial system, because for them this is an extraneous event. It's an extraneous shock. For us, it is actually generated within the system, and the system is flawed, and we haven't actually recognized it. I think that what I'm saying is probably shocking a lot of people who are listening to me here.
Anybody shocked here yet?
I think so. I think it's not. This is not yet accepted.
In other words, market fundamentalism still
is the prevailing.
Affects the way people think.
Very much so. I think so.
Do you see that changing?
Do
you see that?
I see. I mean, there is now some questioning, and I see some of the regulators who are actually very deep-thinking people recognizing that there was something wrong. But the practitioners, of course, have a vested interest in continuing because it has been a very rewarding area. Profits in the financial sector have been fabulous. 40% of total corporate earnings came from the financial, were in the financial sector. That's a pretty excessive figure. It cannot be maintained, and it's not really very efficient either.
What are the other implications if you accept your argument that markets don't tend towards equilibrium? One argument, obviously, is this enhanced power for regulators like the Federal Reserve. But what are the other implications as as more people come to accept that argument?
Well, I think it actually makes markets more unstable because you know, you used to have